Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, September 29th, 2020. What we're going to do is take a look at the equity markets. We'll start out there. Won't be too long. Do want to cover a few things that I've touched on recently and a couple new things as well. And then we'll very briefly look at crude oil. We did get a breakdown of that 60-minute symmetrical triangle I highlighted. I want to do an update on natural gas. I think there's a great example there, trading example. And then an update on gold, silver, and US dollar, and something I want to point out there as well. All right, starting out with QQQ and SPY, we did get those short-term, near-term sell signals on the trendline breaks. And they didn't play out for a whole lot so far. Mostly some consolidation. QQQ is down today, but not too much. Based on what I'm looking at, there's, I think, decent chance of more downside, but you know how much it's, I don't know if it's worth it to game a pullback. It certainly is if we go down more. So what I would say, there's active traders that will welcome a quick pullback, a couple points on QQQ, or especially if you're trading futures. And then there's always the chance that these bullish developments, these divergences and everything will get sold into just as this rally starts to look good, based on some of the bearish developments that we've had on the longer term charts, some of which I'll touch on here shortly. So that's it. Again, near term sell signal. So far, really not much of a pullback, just more so consolidation right there. And we are below that minor trend line. A couple other things to note. We have pending. Now, it hasn't happened yet. We rally up, futures rally tonight, and we jump up here and we hit that next target at 280.32. We're probably not going to get it, but we have a pending bearish PPO crossover. That is when this PPO line, the blue line, crosses down below the signal line, which is that white line, or the 90 MA. So right now they're poised to cross, but they haven't done so yet. And what you want to look for, look for high-level bearish PPO crossovers. In other words, especially when they're above the zero line, that's the dotted line there. That's what you want to look for during an uptrend. And last time we had one was right here. Again, if we get one there, and before that was right here. So you can see what happened. That one coincided with that sell signal way back then in the early beginning of this month, early September. And this one right here, if I follow up, came shortly after that minor uptrend line break, with quite a bit of downside to come, one of the bigger drops since the whole thing started. So that's it. So we'll look at that. We have something similar on the SPY 60-minute chart. If I can pull that up, here we go. SPY, again, SPY stalled out really yesterday, ran into that 335.12 resistance right there, and that capped the advance. And then it followed suit with QQQ breaking below the minor uptrend line today, pulled back to really the minimum target. And, there's a possibility this could be it. We're coming off a strong divergent low. Price action's been strong the last few days. Maybe we consolidate, pop up. Hate to even give odds at this point, whether we're going to go down more or not. So trade it as you think markets are going to go. And if you're not sure, don't be in the market. If you're long, set stops somewhere below that support level right there. Again, depend on what you're going for. If you're looking for the road to new highs and beyond, then you can obviously allow for a much wider stop, because it's all about risk reward. Every trade you take, you need to look at what is the profit potential on that trade. So if it's 30%, how much am I willing to lose? Well, a 3-to-1 risk-reward ratio is attractive, and that means you could use a 10% stop. If you're an active trader and you're only going for a 1-2% pullback, well, your stop is going to be probably a fraction of 1%. So that's it. Sell signals, and again, you can see the on SPY as well, a pending. Any more downside, we get a bearish PPO crossover. So based on this, and the fact that we have hit that 32.8% fib retracement, I'm going to say I'm leaning towards more downside. That's what I'm going to give you right now, whether it happens or not. We do have the gap below right there, but that's my current preferred scenario, is a little more downside into tomorrow, maybe with the futures tonight. There's your last two bearish PPO crossovers that came when the PPO was above that signal line. I'm sorry, above the zero line right there. And again, they both proved to be pretty good shorting ops, or get out of your long ops there. Now, speaking of that, let's move over all the way here to a weekly time frame, and let's go to QQQ. You can see it here on SPY, almost what I'm about to talk about. Talking about the same thing, the PPO bearish PPO crossovers. Now, this is a histogram. Here's a price percentage oscillator, which is similar to MACD, but I much prefer this on long-term time frames like this. You just get better separations with the lines, a close cousin to the MACD. But you can see there is our recent bearish PPO crossover, where the blue line crossed down below the white line, and that's represented on the histogram. When the blue line, the PPO line, is above the signal line, you have a green histogram. And the higher the differential between the two, I mean, farther away the blue line is from the white line, the higher the histogram will be. And so when the two cross, it flips to red. So we can just look at the histogram here, especially in the video. It's a little easier for you to see when the crossovers occur. So as I mentioned the other day, we had the first bearish PPO crossover now since right here when COVID first started affecting the markets, and they had peaked out in late February, and that signal came early on. Even if you waited till the weekly confirmation, this is a weekly chart, so you would have had that confirmation at the end of that week ending Friday, February 28th, and that's that red candle. You go to the bottom part there. There was still another 20% downside to come. So these are not exact timing indicators, but they're worth noting. So we go back to this one right here. That one, although it was too late, we'll call it a whipsaw. There was a little downside, and I'll measure it out for you here. I can do that with my the pop-up box to the left. There was a couple percentage points, but at the very least the market didn't go anywhere. It went sideways for a few weeks. There was the one before that, and again, you may want to call these whipsaws. You certainly could, but there was a little more downside there, about 3%, and I'll consider those whipsaw signals because you didn't get those clean hills to follow. This is what I refer to as a hill. There's a big green hill, big red hill, upside down hill, if you will. And again, go back before that, and there was your crossover right there, and that was preceded a almost 23% drop in QQQ. And you can go back in time and you can see that it's not a perfect indicator, and that's why I don't, if it was that easy, guess what? I just have an automated program that would flip me long every time we had the bullish crossover and flip me short every time we had the bearish crossover. So I use this in conjunction with other technicals. For example, with Apple, we just recently broke the uptrend line on the weekly chart, and we're still below it right now. And so what I'm doing here is I'm flipping back to the longer term, bigger picture, and these are things that may override or limit those bullish developments that I've highlighted on the 60-minute charts that are in play right now with the rally we've had for the last few days, and, minus a little bit of a consolidation today. Apple. Okay, so there was our first bearish PPO crossover on the weekly chart. That was at the end of last week. Remember, this one won't be finalized. This PPO bar right there, the histogram bar, doesn't get finalized till Friday. So it's red right now, but if we go back up and Apple rallies strong, you could close back above there, and then that would prove to be a whipsaw. Here's a whipsaw right there, for example. We crossed, and then boom, right after that we crossed back up. So there's, like I said, nothing is perfect, but if you go back, the track record's pretty darn good. Here was a big green hill. That's what you want to look for, nice separation between the PPO lines. And then there was your crossover. And if you waited to the end of the week, there was still another 22.23% downside in Apple. If you even, again, waited for that signal to confirm on Friday. There were a lot of other sell signals. We were short, we had breakdowns, trend line breaks, and everything else. That just confirmed a more significant trend change. And, indicated there was more downside to come, even though that was one of the biggest pullbacks at the time when that signal finally came. All right, so whipsaw. The time before that, you can see right here on Apple. And again, what I'm doing is going up to the candle that closed the week that the signal triggered. Excuse me. And it's 35.25% downside in Apple. So here's the thing. Are there whipsaws? Yes, there are whipsaws, plenty of them, and so it's not a standalone, but it's something to be respected because the biggest trend changes that we've had, and remember this whole thing, we're talking about the PPO, it is a momentum indicator, and what it shows you is when the momentum is waning. So when it starts moving down, the momentum is waning. The trend may still be up, but it's losing momentum, and that's what the stock market's all about. That's what swing and trend trading is all about, catching those ebbs and flows. So I just want to mention that we have most of the market-leading FANG stocks and NASDAQ 100 on those sell signals there. When you look at SPY, close. but not there yet. I mentioned that a couple weeks ago. That's something, that's kind of giving me some pause there. But again, if we take another leg down, especially, again, it's all about, let's go back to these 60-minute charts, these recent lows. So this seemingly little, innocuous so far pullback or correction starts to morph into something more, and we take another run at and take out those lows. Like I said, I still expect waterfall selling if and when the recent lows on QQQ are taken out. So there's your big magic number there, and that's why I'm a little skeptical, but acknowledging the bullish developments here, but a little skeptical on whether or not this is going to be the next big ride up to new highs and beyond. Remember, we had that last time we had bullish divergence of this magnitude was all the way back here and heading into the March lows. About equal divergences. When I'm talking about the magnitude, I'm talking about the the duration and the slope of the divergence lines right there. There's QQQ, and that was a catalyst for this whole thing so far. Well, it was a catalyst to get it started. Obviously, the Fed dumped a lot of gasoline on the fire there to really ramp it up. But so that's it. Talked much about that quite a bit recently, and they're to be respected, but there are all those long-term cross currents in place right now that make me lean toward the fact that we're not going to see this to be the catalyst to new highs and beyond. Okay, everything else we'll go through a little quicker and we'll wrap this video up. Yesterday, I think it was, I highlighted this symmetrical triangle pattern, saying the next break above or below would most likely determine the next tradable trend in crude, and there it is. That is a 4% drop, and this is technical analysis. That, as I said yesterday, a very well-defined uptrend line. The more reactions you have, the better defined it is, and to me, my interpretation of how technical analysis works is the better defined it is, the more obvious it is. So therefore, there's a bigger pool of traders and investors out there that are going to act on that when that line breaks. If it's some obscure trend line drawing, that you really have to make fit. That's the thing about trend line drawing. I don't try to force it. If I have to force a trend line, it's not even worth it. So the better, cleaner they are, the more likely they are to play out. And that was it. So there was your quick 4% drop in crude on the break. Where do we go from here? I don't know. That was a swift move. It's near-term oversold, and I don't have a lot of good support levels. I can just tell you that was a near-term sell signal, and maybe if crude rallies back up and give you another objective short entry, we're kind of in no man's land now. Like I said, I don't have any solid targets. I just wanted to update that because, as I said, if that broke down, it wouldn't be good for the coal stocks, and I don't think they did so hot today. I didn't plan to include them in the update. I just right now, remember mentioning that yesterday, that watch crude, and that's that. So if you're a quick trader, you were able to catch that today. The other one is natural gas. Now, this one I mentioned is being in a bullish setup. I talked about this potential inverse head and shoulders pattern. So what I'm using, this is a great example. So there are two ways to trade this. The conventional method, and a little more conservative, or again, more conventional, I should say. There's nothing conservative about trading natural gas. In fact, those two words should not be used in the same sentence because this is one of the most volatile commodities out there. But I did say, break above 219 is a break above the neckline of the pattern. That's an objective long entry and a buy signal, and that would take us up there. Or you can take the aggressive route, which sometimes I'll do, and when you recognize a pattern like that, again an inverse head and shoulders bottoming pattern, you see what appears to be a right shoulder form, and you can go long at that right shoulder because you had support there with a stop just below, somewhat below there, and that's exactly what happened. It didn't pan out. We never finalized that pattern. We never got our buy signal on the break of there. We never even put in the right shoulder, never moved back up. What we did is the pattern was foiled on the breakdown today, and and that's, again, like I say, don't fall in love with any trade at all. And what I'm trying to do is measure it out for you. I'm going to have to do it differently because if I grab near there, it'll move that line. So what I'm doing is I'm measuring to 7.92. There's an 8% drop, and again, that's where a stop, well-placed stop, would have averted that 8% or a good part of the 8% drop today. And so the pattern's foiled right now, at least the inverse head and shoulders pattern. The only thing to point out is it doesn't mean natural gas now can't turn around and rally. There is I'm going to go over here to this reaction low right here. I wish there were more reactions. Maybe there are. If I go back a little farther in time, there's 2 reactions right around the same level. I'm going to put a little support zone here from about there to there, and say that if natural gas moves down a little more and then reverses, look what we're going to have. I'm extending these divergence lines. I'm just taking this one, and we have the potential to put in a much larger divergent low. So what that means is natural gas is still very much on my radar. At this point in time, it's in free fall with absolutely 0 buy signals, nothing remotely close to a buy signal. But if it can reverse here, turn this PPO back up, and put in a divergent low, then there's a potential that we do go up. And now price targets, I can tell you on the way up, would be 2708. The fact that when we broke that 2708 level, we didn't just kind of meander on around and trade around there. We went into free fall, tells me that that was a very significant level. I mean, I could look at it here. There were enough reactions lately, but the fact that the sellers just stepped in hard and longs ran out of natural, jumped out of natural gas, say that, hey, that was a significant level. So as such, it's most likely to be a resistance level or potential target on the way up. And one more thing, I'm looking here. We might have a trend line that comes into play like this, so we'll watch for that. And then next target, if 2708 is taken out, same ones, 2915, and then this potential trend line, and then 3146. Again, potential setup right now, but I just wanted to mention that as a trading example of hey, don't fall in love with especially natural gas, because if anything can cause you a lot of pain or a lot of pleasure very fast, it is natural gas. I've seen this thing run up easily double digits in a day, and then I've seen it do it again and again. 10-12% gains. You don't always get that, but it moves fast. All right, let's move on to gold, silver, and the US dollar. All right, I'll start with gold. This is another great example of what I talk about, how there's a unmistakable longer-term inverse correlation between gold and the US dollar, meaning when the dollar goes up, the price of gold typically goes down, and vice versa. And it's simple because a rising dollar, it takes fewer dollars to buy a share of gold, and a falling dollar takes more dollars to buy a share of gold. But there are times and periods, and it can be minutes, days, sometimes even weeks or months, where there's a disconnect. So where I'm going, let's go loop back around to the currencies. Let's look at the dollar. This was DX. So as I updated today, I was highlighting this bearish rising wedge pattern, the negative divergences forming in the dollar last week. We broke down, we put in that divergent high, and we've been moving lower. So as I highlighted today, we hit my first target. This is a target zone. It was a resistance zone that we broke out of, longer term bullish. And so here's my scenario for the dollar, this or this. One of those two. It's a relatively tight zone. That's my preferred scenario for the dollar. So at this point in time, like I said earlier today, the dollar hit support. Now that's quite often where you'll see had the dollar bounced off that support, which is what I was leaning towards, but it didn't. Had it bounced off, it probably would have caused a pullback in gold. But what happened is the dollar hit that level and continued to trade on there, just like the euro, I pointed out, hit the top of my minimum bounce target zone, which was here, 11.1735 to 11.1755. Nice and well-defined. It was all support back here, and it broke down there. So these guys hit their minimum target, but guess what? They didn't pull back, and as such, gold and silver didn't correct. And sometimes you can see the dollar pull back and gold not go the other direction. But we're close now. So the gold, my minimum target, it was 1911. We're getting closer, and I just want to mention that as I'm doing this video right now, and the dollar and the euro will trade overnight, they're still at support, and they still may bounce. Gold is so close to that first target, it'd be hard to not see it hit it before a meaningful pullback, but that's still what I think is going to happen. I think we'll get probably tonight or tomorrow, most likely, get that reaction on the dollar and the euro, and maybe a little pullback in gold, followed by the next thrust up, next leg up there. Same thing on silver. Silver continued to power up today because although gold and euro hit resistance, they did not have, or support and resistance, they did not reverse and have a reaction. So silver, same thing, very close to my next target there at 24,833. Almost be hard to imagine not hitting it now. Why? Because usually when you get that close to a target or resistance level, it's almost like a magnet, or a black hole that pulls everything in around it. But again, not if we get a pretty sharp bounce in the dollar and euro there. So close enough. What do you do? Well, trail stops up if you're long, or if you're not a very active trader. Again, I made my thoughts pretty clear. I think these guys go up more. I think there's more upside in gold and silver. So to me, it's just a matter, do we get this or this? And so, as a swing trader, you might just want to, set your stops somewhere a little bit lower. If you're holding out for a move up there on silver, that would be 26,220. Oh, after the next target of 24,833. And there's still a good chance we'll get a reaction off that target if hit. And maybe that's going to be it. I don't know, but I'm leaning this way now, a little more upside. Okay, and that's it. Those are the things I wanted to cover today. And, if I'm feeling a little bit better tomorrow, I had to stay away from my desk most of the day today. It was this COVID thing. It's the weirdest thing. Sometimes you're feeling almost back to 100% normal, and then an hour later you're like, wow, today was one of the worst days I've had in 3 or 4 weeks. So I'm keeping an eye on these right now. I'll stay focused on the gold and the precious metals trade. Any updates on natural gas or crude oil that are relevant, I'll post. And of course, the equity markets, I'm going to keep close tabs on those. Time permitting, I'll take a look at some of the other recently highlighted trade ideas, including but not limited to the coal stocks. But we're going to wrap this one up here. This has been Randy Finney with Right Side of the Chart. Have a great evening.